I developed robust strategies for years, and I found this. In my earlier years of trading, I always thought that finding a profitable strategy was mainly about building the right entry rules, finding the perfect indicator, finding the perfect setup, or finding the perfect combination of conditions, for example. But after testing hundreds of strategies and running countless backtests, I started noticing something. The strategy itself was rarely the biggest problem. The biggest problem was that most traders never actually test their strategy as robust. They find something that works historically, they optimize it, and then they immediately assume they found an edge. But what they don't realize is that a backtest is only one possible version of history. And there are thousands of other ways those same trades could have happened. So the question becomes, how do you know if your strategy is actually good or if you simply got lucky with the historical data? And this is exactly where robustness testing comes in. Methods like Monte Carlo simulation, block bootstrap, and perturbation testing help you separate a real edge from results that only look good because of random chance. And in this video, I'm going to show you how each of these methods works, what weaknesses they reveal, and why they can completely change the way you evaluate a trading strategy. Now, most traders have heard of Monte Carlo simulations, but I'll briefly go over it again anyway before we move on to the more complex topics. Let's say you have a strategy with 500 historical trades. You have every single result, your winners, your losers, your drawdowns, everything. A normal backtest gives you one specific path. Trade 1 happened first, trade 2 happened second, and so on. That creates your equity curve. But here's the problem. That exact sequence only happened once. There are thousands of other possible sequences that could have happened. What if your losing trades happened earlier? Or what if you experience a 15-trade losing streak right at the beginning? This is where Monte Carlo helps. Instead of changing the actual trades, it changes the order of those trades. It randomly reshuffles them thousands of times. And every single simulation creates a slightly different equity curve. Two traders can use the exact same strategy and get completely different experiences depending on the order of their trades. One person might have a smooth equity curve, another person might experience a massive drawdown before eventually reaching the same result. And this is where concepts like drawdown distribution become important. Instead of only looking at your historical maximum drawdown, Monte Carlo shows you a range of possible drawdowns. Maybe your backtest shows a 10% drawdown. But after thousands of simulations, you discover that 20% or 25% drawdowns are completely possible. That changes how you think about risk. It changes your position sizing. Another important thing Monte Carlo can show is losing streak distribution. Most traders underestimate losing streaks because they only look at what happened historically. But randomness can create sequences that never appeared in your original backtest. A strategy that historically had 7 losses in a row might realistically experience 12 or 15 losses. And if your position sizing cannot handle that, this strategy might not be as robust as you thought. This also connects to something called risk of ruin. A strategy can have positive returns, it can have a profitable backtest. But if the risk is too high, a bad sequence of trades can still cause catastrophic losses, and Monte Carlo helps estimate how likely those situations are. Now at this point, Monte Carlo already sounds extremely powerful, but there is one major problem. Simple Monte Carlo destroys market structure, because when you randomly shuffle individual trades, you remove something that is extremely important in financial markets, and that is clustering. For example, volatility does not randomly appear for one candle and disappear immediately. High volatility usually follows high volatility. Low volatility usually follows low volatility. This is called volatility clustering. The same thing happens with market regimes. A trending market behaves differently from a ranging market. A high interest rate environment behaves differently from a low interest rate environment. And strategies often perform differently depending on these conditions. But when you randomly shuffle every single trade, you break these relationships. You separate trades that originally happened together, and this creates a problem because the simulation becomes more random than the market itself. It's kind of like taking a movie and mixing every single frame randomly. All the individual frames are still there, but the story is gone. And that's exactly why another method becomes interesting. Block Bootstrap. Now, block Bootstrap sounds complicated, but the idea is actually quite simple. Instead of randomly moving individual trades, you move groups of trades. It keeps completed sections together. This means keeping sequences together. Instead of separating every winning trade and every losing trade, you preserve blocks of market behavior. This means trends can remain trends. Volatility periods stay together, and losing streaks remain realistic. This creates Monte Carlo simulations that are often much closer to how markets actually behave. Now, while block bootstrap solves one problem, there is still another question. Because even if your trade sequence is realistic, your execution probably isn't. And this leads into another robustness method called perturbation testing. Now, perturbation testing is a completely different idea. Instead of changing the order of trades to intentionally make your strategy worse, you add realistic problems. For example, what happens if your commissions are slightly higher? What if you experience more slippage? Or what happens if your losses become slightly larger? Because this is what live trading actually looks like. The important question is, does your strategy still work when conditions become slightly worse? Because if a tiny change completely destroys your results, then your strategy probably depended on unrealistic assumptions. And this is one of the easiest ways to detect overfitting. An overfit strategy usually looks amazing under perfect conditions, but the moment you introduce small changes, the performance disappears. A robust strategy is different. It might perform slightly worse, but it survives. And that is what you actually want. Now, this leads to the biggest lesson from all of these tests. Professional traders don't use one robustness test and assume they are done. They combine multiple methods because each one attacks a different weakness. Together, they create a much clearer picture of whether a strategy actually has an edge. And the best strategies are not the ones that only work under perfect historical conditions. They're the ones that continue working when reality doesn't go exactly according to plan.